Levels of resistance. Let me tell you that this lesson on support and resistance is going to be the most important lesson that you will receive, because understanding support and resistance is going to provide you with the absolutely essential foundation that you will need to apply all of your other tools and to make decisions in trading the market, and it will offer you the best discretionary analysis of the market, is understanding support and resistance and how these levels of support and resistance are established from the incoming flows and from the dealing in the major institutions and the CTAs and so forth. It is absolutely critical, so please do not just pass over this lesson. Pay attention, as it is critical and will be referred to in all of our lessons to come. Levels of resistance are candlestick highs that the bulls must continue with to make higher highs. When price comes up and makes a very distinct high, then at some future date, there's a reason why price moved to this high and did not move above this specific price point. And that is because of potentially a multitude of factors. Whether it was based on a news or geopolitical event or economic data that had come out, or the market had simply, based on their assessment, decided that that this currency cross valuation was not worthy of a higher price. Therefore, that makes this point very, very important now and at a future date, particularly levels of resistance that occur on a higher time frame. Now, the market rallied to this price for a specific reason, and we are to watch this at a future date. As price has retraced here, now if the bulls want to make any money, they're going to have to move up, of course, and they're going to have to contend with this high at some future date. We see here that we have a market price is currently right here, and if you are long or bullish, short, medium, or long term, you're going to have to contend with specific price points that are very clearly established levels of resistance in the past. Now, a level of resistance can be established by having one or two or more candles on either side of the wick high candle. Now, the more candlesticks to the left or to the right that are lower, the more profound or more distinct this level of resistance is. For example, this level of resistance has more candles to the left and more candles to the right than this candle does, therefore making this a more profound level of resistance. It also depends on where it occurs in the day or the week or the month and so forth, which we can distinguish on the higher time frames. We'll discuss that in a moment. Again, we have a very profound level of resistance here, a smaller level of resistance here, and then a more profound level of resistance up here. What's important to note is that as the market moves forward or upwards, you will see very distinct price action once price meets that exact high that is denoted on the high of this candlestick wick. And you'll see that typically the market will respect that level, and you may see some selling pressure. Number one, you'll see a selling pressure that occurs at this level, and you'll also see a decline in buying interest at this level as well. Now, this chart here is a 60-minute chart, and we're going to show you this on different types of time frames. This is a daily chart now, and here's our current market price, and we see very distinct high points on this daily chart. Now, the highs on a daily chart are absolutely must be acknowledged and brought into consideration when you are trading, because the major flows and the major institutions are watching these levels very closely, and you'll most often see as price rallies to specific price points, particularly this one, which is very profound and stands out among other high points, you will see distinct selling pressure at or about this high point. We see here price has been making down price cycles, and with each retracement we establish a key high point or a key level of resistance with each retracement. Now, as price here retraces, if it retraces even deeper, it's going to have to contend with these levels. As this is a 60-minute chart or a 60-minute time frame, you'll see that these are interim high points. Each of these high points is an interim high point, as we're only covering a period of approximately 8 days, versus looking at a daily chart as we saw previously. This covers a period of, if you look in your books, a period of over 1 year. I'm sorry, over 5 months, a period of approximately 5 months, versus a period of about 8 days. Now, if you're trading intraday, you can see how the smaller time frames, the support and resistance on the smaller time frames will be important. Taking it even lower now, this is a 15-minute chart. As the price cycles or price swings, we are making lower highs and lower lows, lower highs and lower lows, lower high and lower low. Market price is currently here. If we are bullish, we are going to have to contend with these interim or intraday highs and move above them if we want our trade to continue to pay. You can see on this 15-minute chart that we're covering a period of only approximately a day and a half to 2 days. And we see a lower prices making lower highs and lower lows in a day and a half to 2 days basis, versus a 60-minute chart where it's extended over 8 days. And on the 15-minute chart, we cannot even see some of the highs and lows that have been established on the 15-minute chart on this 60-minute chart.